Hello and welcome to Moneylife. This is Sucheta Dalal. We're in the middle of a war, but let's not talk about it because I'm sure all of you are obsessed with it. Instead, if you're a trader, let's talk about the Securities and Exchange Board of India and how it has done over the last year. Why the last year? Because Tuhin Kanta Pandey, the present chairman, completed 1 year at the head of the regulatory body at the end of February. This milestone was well marked with a series of interviews and media conversations which highlighted a few facts. A year of calm, stability, and apparently 58 regulatory changes that have followed a period, as you know, of prolonged turmoil and controversy that surrounded his predecessor. In fact, it had shaken up the regulatory body and it had eroded confidence. And indeed, if you look back, it has been a year of calm in spite of what has been going on in terms of roiling the global markets. So it's hard to dispute this claim. Indeed, despite the tremors triggered by the Iran war, Indian markets have remained remarkably stable even after foreign institutional investors have pulled out approximately 5.32 lakh crore since late 2024. So, foreign investors are pulling out money, Indians are putting money through mutual funds, and markets have been fairly stable, and except, of course, small cap stocks where the speculative bull run has ended. Let's now look at the chairman's term. The irony is that, in spite of all this calm and the reforms and stability, one of the first things that he did as chairman has remained incomplete. So also his boldest enforcement action. So let's look at these two big gaps. One is the code of conflict for senior SEBI whole-time members and the chairman himself and the board of directors. So we know that that was controversial. You have seen my video blogs in the past under Chairperson Madhvi Puri Buch. So when Mr. Pandey was appointed, one of the first things he did in March 2025 was to set up this high-level committee to review this conflict of interest code that was applicable only to the top brass, which is 4 people, because the rest of them, it wasn't really applicable. They're government servants. And the rest of SEBI's officials, down to the rank and file, had a completely different and stricter code. Now, the committee's report was good, very unusual, candid. It pointed out how the top 4 had conveniently escaped these stricter rules and recommended several far reaching measures. They included public disclosure of assets and liabilities by the senior leadership and the fact that the chairman and whole time member, remember, they have a look on every regulatory action that's happening throughout the organization. They're not working in silos. So they would be treated as insiders under SEBI's insider trading rules. And it had tighter trading restrictions, creation of a whistleblower mechanism, and an ethics oversight framework. All this has been discussed in previous video blogs and Moneylife articles that I have written. So, a year later, these recommendations have not been implemented. They remain a work in progress under consideration, apparently going to be taken up at the next board meeting. But if that was the number one priority, shouldn't it have been done? Apparently, some insiders are objecting to the kind of public disclosure that is expected, but then they are in regulatory functions, aren't they? So let's see what happens at the board meeting. It's a work undone. And it goes back to a familiar pattern in India's regulatory reform, where when it comes to people in position of power, the system crawls. Remember, these regulations go back to 2008, and we have written about how weird this voluntary code was. I wrote a piece about how the conflict of interest code is a riddle wrapped up in a mystery inside an enigma. And that remains in place. It remained in place after several chairmen. It remained in place after hundreds of rules were changed for everybody else. They remain in place 1 year later. Not a good thing. Now, if the conflict of code is about SEBI's own credibility, enforcement is about its authority. So here again, great start in one of its most aggressive enforcement actions ever in the history of the Securities and Exchange Board of India. SEBI cracked down on the high-profile US trading firm Jane Street. This made global headlines. This happened in July 2025. SEBI issued an interim order accusing the firm of manipulating settlement prices in the Bank Nifty index through a complex strategies that combined cash and derivative positions. Now, the regulator barred the firm overnight from the Indian market and ordered impounding of a humongous 4,800 crore, which it alleged were unlawful gains. Now, the interesting part was Jane Street issued the usual denials but paid up with great alacrity and resumed trading. When people were surprised about this, a top SEBI insider had then told me, "We will be watching Jane Street every day like a hawk." Well, they are apparently watching. Jane Street is trading and no final order has been issued. Embarrassing, right? SEBI has shown no urgency, even after the global significance of the case. And there's a context. India is now the largest derivatives market in the world in terms of trading volumes, and these are fueled by high frequency trading and extraordinarily sophisticated algorithms. So, the inability to complete such an important high profile investigation in a timely manner and issue a final order sends a poor signal about our regulatory accountability. Meanwhile, the derivatives trading itself remains a major challenge, but things have happened over there, some fixing. So, one, the union budget attempted to dampen enthusiasm among retail traders by increasing the securities transaction tax on futures and options. This was after several consecutive SEBI studies showed that 90% of retail investors, or let's call them traders, lost money in derivatives trading. This was year after year, so now you have higher STT. Hasn't made much of a difference, dampened it slightly. Now, in the run up to this, Mr. Pandey had attempted to curb speculation through several incremental changes, such as limiting the number of derivative expiry days, tightening monitoring of intraday positions, adjusting index composition rules to reduce the possibility of manipulation. So, here again, it's not that Mr. Pandey hasn't done anything, there's a lot of small incremental actions. But between the Chain Street episode and the regulatory curves, the larger structural question remains unaddressed, which is, has India's derivatives market grown disproportionately relative to the underlying cash market? Or has the lack of depth in the market stunted the development of sectoral indices? Now, another work in progress, which has helped in a way, is the restructuring of key indices. So, Bank Nifty, BankX, Nifty Financial Services have been restructured in November 2025, which is another of the 58 reforms and has had a positive impact because concentration of speculation, which was entirely in the Bank Nifty, has reduced. So, certainly positive strokes, stability, and caution. And let me elaborate a little more on the positives that he's done. Mr. Pandey's first year has led to administrative calm, avoided the fast and furious changes that we saw in the previous 3-4 years. Every weekend there's something new, roiling people, everyone scrabbling around to comply, and yet, like I said, the rules didn't apply to the chairman and the whole time members. So, this time, in spite of the global shocks and the constant changes thanks to President Trump's pronouncements, the Indian market has been fairly calm, as is reflected in the continued boom in successful listings of initial public offerings. Another important decision was that the National Stock Exchange finally got its no objection certificate after a whole decade. It's pending since 2016. NSE's new management, of course, worked at it by going to SEBI and saying, let's have an amicable closure and we will pay whatever fine is required, just the opposite of what the previous management was doing. So, all pending appeals and litigations are supposed to be settled. There's one in the Supreme Court that's not yet been done. So, maybe when that is done, NSE would be in a position to submit its draft red herring prospectus. Given how NSE still has a monopoly and how profitable it is, it will again add an important company which adds to the depth of the market. Whether exchanges should be listed at all, unfortunately, that ship has sailed. So, coming back to the chairman, very well begun, but half done. So, overall, it's good. His industry interactions, speeches have also repeatedly emphasized market resilience cannot be ensured by the regulator alone. It is a shared responsibility among market infrastructure institutions, intermediaries, fintech innovators, and all participants in the ecosystem. And that is how it should be. So his approach has been one of pragmatism and incremental reform. He's also walked the talk on the finfluencers malpractice. He's launched Sudarshan, an artificial intelligence based surveillance tool, removed 1,20,000 misleading posts, and that's important. This has been done in collaboration with social media platforms, and he has initiated really strong action against high profile trainers, influencers, and television anchors. We've been reporting this, so we won't go back to it. Here's some images, but much remains to be done. One is the whole SME listing sector. It's a hotbed of speculation and manipulation. SEBI is aware of it, it has acknowledged the risks, and it needs to put in place a comprehensive corrective framework. Hopefully, it's being worked out. Similarly, Mr. Pandey has emphasized on optimum regulation, which is good, but it should extend to the functioning of SEBI's own enforcement and investigation arms. When we talk about the good work, we praise it, it has to be followed through with orders that stick. SEBI's orders have repeatedly been struck down by appellate bodies and also the Supreme Court. In fact, it's faced so many embarrassing strictures due to procedural lapses, weak evidence, inordinate delays, and occasional regulatory overreach. In fact, sometimes even vendetta. What is required internally is an institutional mechanism that has mandatory precedent audits. You decide a case in a particular way, that should be the precedent internally. It's not that a new officer or a new WTM decides something exactly the opposite because he feels like it. It has to be justified. There have to be standardized evidentiary protocols, independent enforcement review, and there have to be career consequences for officials who do a slipshod job or who do a vindictive action against people, or sometimes, as we have seen, corrupt action. This would go a long way in strengthening SEBI's credibility. One of the really positive developments on this front happened after Mr. Pandey's 1 year was completed. So on 20th February, SEBI issued suddenly an internal order suspending General Manager Achal Singh pending investigation because of concerns related to vigilance and misuse of position, some say even corruption. Now, this is important and significant. The chairman has addressed this openly by saying that SEBI will get to the bottom of it, and he has noted that failure to act could discourage other officials who perform their roles with integrity and honesty. So, as Mr. Pandey begins his second year as chairman, it's fair to say that he has fulfilled his primary objective of stabilizing SEBI, not yet completed the credibility part for senior management, but has rebuilt confidence and is working towards what he calls optimum regulation. But remember, a chairman's term is not decided by his first year, but by the full term. And that will depend on three important things. One, this credible code of conduct for SEBI's leadership, which has to have the same zero tolerance that was demonstrated with one general manager called Achal Singh. Second, ensuring enforcement consistency and timely closure of high profile cases like Jane Street and others. We've had embarrassing things dragging for decades, sometimes 20 years, cannot happen. And addressing structural issues in the market, such as the imbalance in derivatives trading, deeper corporate bond market, or genuine ease of doing business for intermediaries who play by the rules. So, how would you judge Mr. Pandey's term? I would say, job well begun, but still half done. And the harder part lies ahead. Tell me if you agree. Love to hear your feedback, and do subscribe and share. Thank you.